pleasure to have an interesting guest. I have someone who's been on many times before over the years, and every time he's come on, people who've watched this show said they enjoyed it. They got a lot of good information. So we have, once again, attorney Paul Abreu.
Hi, Richard. Good
How
to
are
be here
things
again.
going?
Survive the winter, or try to.
So where is your office now, once again?
I'm in Norton, 123, still in Bristol County. A lot of people think it's another country, but
Yeah,
Norton is.
Norton. Now, did you have any problems driving down here?
No, not today. No.
Roads are nice and clear.
Yeah.
There's people speeding along the highway like usual.
Yeah, but it's been a tough winter to get around. All the closings and whatnot.
Now, on Route 24, did you encounter any potholes?
It's nasty.
No kidding.
Yeah.
That people are traveling fast, 60, 70 miles an hour.
Mm-hmm.
Well, anyway, your practice consists of what?
Doing real estate, representing lenders mostly, doing closings when people get a mortgage. I'm the one that comes with all the paperwork. I also represent the buyers and sellers of when you're selling your home or buying a home. So pretty much that. Do some estate plan, but mostly the real estate.
And you take care of most of this in your own office or at the bank or at the lender's office?
At my office usually, or go to the registry of deeds. Now everything is electronic as far as you can do recordings at the registry of deeds from your office. You don't have to go to the registry of deeds to record anymore. So.
And title searches?
Title searches, same thing. You know, you can do a lot of that online. So.
Quite convenient.
Yep.
So you don't have to go to the books?
Right.
Pull them off the shelf?
No. Get all the dust on you and whatnot. And, yeah.
Yeah, it would be tough.
Things have changed
This
from
past
those days.
winter, yeah. So all the, you're in Bristol County, and that's where you do the bulk of your work, in Bristol County?
Bristol County and pretty much all of Eastern Mass. Yeah.
Now, all the registries are accessible electronically?
Yep. All of them. New Bedford actually was the last one, just a couple weeks ago, that started to accept
is that
electronic
right?
recordings. So now everybody is accepting electronic recordings.
Now, there have been a number of legal cases in regards to mortgages that, what they call MERS, M-E-R-S,
Yep.
Mortgage Electronic
Registration systems.
System.
Yep.
And is that working its way through the system in a sense? Because in the very beginning, it was quite confusing. Is that correct?
It was somewhat confusing. I guess you have to go back to why MERS was created in the first place. And it was about 15 years ago that MERS, around then, I don't know the exact date, but there was a problem with mortgages not being discharged or assignments of mortgages not being recorded at the registry of deeds. And that would cause title issues for the homeowners. People have, you know, that when you pay off a mortgage, the way that there's proof that that is paid off at the registry of deeds is that a discharge of the mortgage is recorded at the registry of deeds. Unfortunately, banks were not doing that. A lot of them weren't, or their discharges would be missing, or when there's...
Is that because they didn't have the mortgage any longer?
Right, they didn't have the mortgage, they had sold it, and they didn't record the assignment. So let's say like...
Oh, so the banks didn't record the assignment?
Right, so they
you'd go down there and...
You would think, say the mortgage is in, say, we won't use a real bank's name, we'll just say ABC Bank is on record at the registry of deeds is holding that mortgage, but you paid off XYZ Bank, and XYZ Bank records the discharge, but you'd be looking for the discharge from ABC Bank, and it's not there, and there's no assignment from ABC to XYZ. So MERS was created to avoid all the assignments and whatnot, so that it's
Is MERS a private company, corporation?
It's a private corporation that was basically created by lenders. And also, I mean, it's not all altruistic as far as the lenders go, because obviously they save money by not having to pay the recording fees for all those assignments at the
And the
registry of deeds.
registries were a little unhappy about
Right,
that.
so. And then, so that was ostensibly the reason behind creating MERS. And now, the problem that you're discussing is when the foreclosures happened, that's where, from a legal perspective, the mortgage is in the name of mortgage electronic registration systems, but they really are just kind of a holder at the registry of deeds. They're not the real lender. Mortgage electronic registration systems, MERS, is not
A lender?
a lender. It's just an entity created to like hold the spot for that lender at the registry of
Okay,
deeds.
holds the mortgage in trust? of some
Basically,
sort?
yeah, at the registry of deeds. So then it got complicated. Everything was fine with it until foreclosures started
And no one-
exploding and everybody didn't quite know what to do, because
And I guess
since
people
they
will
don't
be-
really hold the note, mortgage electronic registration systems, can they really foreclose? And that's where the whole legal cases came about. It's not to say if your mortgage, when you did the closing, because MERS is still the vast majority of mortgages now, closing. It
It's
doesn't
still-
mean that you have a problem, so I don't, people at home, don't panic if your mortgage
Don't
was
be calling
recorded
up
in
your
the
bank
name
tomorrow.
of MERS. It was my mortgage of MERS. That's not, it's a technicality when it gets foreclosed, and that's what some people were making legal arguments that.
And then there was some controversy about the note and the mortgage,
Correct.
whether, I guess, the foreclosing party needed to hold both
Correct.
at,
Yeah.
at the same time.
Yep.
And that turned out to be
Not the case.
not the case. So that's a little different than traditional thinking,
Right.
but that's how it is today.
Yes. So they changed the rules, so now they have to record an affidavit with the foreclosure saying that they are the holder of the note and the mortgage. So that has kind of worked itself out in the last year or so after these court cases and regulations coming into place, that most of the foreclosures now are moving forward. There was kind of a lull in the foreclosures because they had to work through all these court cases and get guidance from the courts and regulators. And now that it seems to be kind of straightened out, now the foreclosures can happen and you see more properties coming on the market. with
Yeah, reading these
foreclosures.
cases and these articles, Deutsche Bank seems to come up a lot.
Yes.
That's because.
They were a trustee. And again, it's not that they were a bad bank or anything like that. It gets very complicated with mortgages as far as how mortgages were packaged up in what's called the secondary market. And that's how, again, banks, lenders made money from the mortgages, is that once they gave you a mortgage, they would package that mortgage with everybody else's mortgages and sell them off as what's called
Good
mortgage.
mortgages and not so good mortgages.
Yeah, as mortgage-backed securities, bonds. So they would sell those bonds backed by the mortgages. And the holder of those bonds would be a trustee, say Deutsche Bank, as like just holding those bonds, the mortgage-backed securities. And so technically, Deutsche Bank as trustee for that mortgage-backed security is the holder of that mortgage. So you see them recorded at the registry of deeds in the name of Deutsche Bank. Again, Deutsche Bank wasn't lending the money, they were kind of just the holder in place of the mortgage-backed securities. But their name is everywhere because you'll see their name in the notices of the foreclosures and things like that.
Now, you mentioned that you've been doing some refinancing.
Yeah, so this,
Tell the audience, what does it mean to refinance to begin with?
to refinance is to redo your mortgage, essentially. Pay off your old mortgage with a new mortgage for the purposes of getting a lower interest rate usually, or maybe you're getting more money out of your property. So say you buy your house with a mortgage a few years back and you had an interest rate at say 6%. And you see interest rates go down, now they're around 4% or so. So you're like, well, maybe I can lower my monthly payment. So you contact the bank and they'll say, we'll refinance that. So it's basically paying off the old mortgage at the 6% so that you have the 4% rate.
Now, there's a little thing you have to be aware of, a little caveat, and that is the refinancing charges.
Correct. So there are a lot of options out there nowadays as far as mortgages go. So you can talk to your lender, shop around, because there are a lot of lenders out there that do no points, no closing costs. The interest rate would be a little higher than if you were to pay the closing costs. So you make that comparison as far as like how much money I'm saving by having the lower interest rate as opposed to having a little higher interest rate but not paying closing costs. And it's just a calculation that you make. One thing I've heard, it's...
Now, these calculations, are there, is there any kind of a program?
You can. You could go
computer
online
program?
and like look at the mortgage calculators.
I imagine-
Google mortgage calculator, and you can plug in an interest rate and the loan amount.
Will a lender help you with
And
the...
a lender will help you with that too. A lender can show you if you pay closing costs, this is how much you would be paying in closing costs and what your interest rate would be, as opposed to if the lender pays the closing costs, this is what your interest rate would be and what your monthly payment is. They can go through those options. One thing I've heard recently from people, and it's kind of stuck with people for a long time, kind of a rule of thumb saying that your interest rate would have to come down 2% to be worth your while to refinance. And that was an old way of thinking. That's not the case
The
anymore.
2%?
The 2% rule is not.
Okay.
It's because closing costs have come down, and again, there's the option of not paying closing costs. Back in the day, say 20 years ago, you had to pay closing costs. There really wasn't the option of not paying closing costs. So the 2% rule was because it would cost you so much to refinance that to make it worth your while, you have to save that on the 2%. The other thing is that people's mortgage balances are much higher now than they were 20,
Okay.
30 years ago. So
These
a
big,
percentage different, you know, if you
big
have
houses.
a $300,000 mortgage, a 0.5% is a big
A lot
change
of
in your
money
payment.
over 25,
over
30
years.
years, yeah.
As opposed when that 2% rule of thumb, and it was just a rule of thumb, mortgages were around 100,000, say, as a balance. So really, it really wouldn't make much of a difference having 0.5%. But if you're saving, you know, even $100 a month over 30 years, that's,
A lot of
you know,
money plus
yeah, it's
interest if you-
$36,000 over those years. So just there's really no hard and fast rule as to like when you should look at it. I see people refinancing for just 1/4 of a point, but sometimes that depends on the size of their loan, and it makes a difference.
Now, does it still hold true that when a lender's looking at prospective mortgage, or that they want to know their income? In other words,
Yep,
so much of
so
the
you-
income is basically slated to pay the mortgage. Is it? I'm not sure what the figure was. It was like 75%.
Well, they'll look at a couple what they call ratios, your debt to income ratio, so how much debt you have, so including your car payments, your credit cards and all that, to how much income you bring in each month. And they look at a ratio, and sometimes it's 35%, 40%, 30%. It's the lenders have different rules and different loan programs. So they look at that. Obviously, they look at your credit score. They'll pull your credit report and see what you qualify
Are
for.
they tougher now because, you know, we get
They are
stories
tougher
long ago
now.
with no money down? You
They are
know,
tougher as far as that goes, but there are programs out there for people. There was the HARP program, Home Affordability Program, which allowed people to refinance even though their house was what you would consider underwater,
Underwater?
which means you owe more on your mortgage than the house is worth.
Yeah, that...
So there was a program that the government had in the last few years as far as making it a little easier for those people to refinance the loan. Like, you still had to have your good credit and, you know, your debt to income ratio and things, but it was more of a streamlined process, so you'd still be able to save money. So even if you think that you owe more on your house than it's worth, it's still worth checking with a lender to see if you qualify.
Now, a lot of advertisement on the radio, TV, by some well-known personalities in regards to reverse mortgages.
Mm-hmm.
You have any comments on a reverse mortgage?
Well, if you don't love your kids. No, just kidding.
Well, it's very tempting for some people, of course, that have no savings.
And for a lot of people, it is the perfect kind of program. As far as, again, you look at the reason for the program, and it's that your money is tied into your real estate once you get older. So all your equity, so it's great that you have a $300,000 home, but it doesn't mean anything to you because you can't unlock that $300,000.
Can't buy ice cream with it.
Right. So the reverse mortgage is completely opposite of what you think of mortgages. They give you a lot of different options, but the bank will pay you a monthly sum based on the loan program that you pick out and how much equity you have. Or you can take a lump sum amount for the reverse mortgage. You're not making any payments to the bank, ever, okay? The loan doesn't get paid off until you pass away. And then the family has a year to pay off the loan after you pass away. So it's a great way for a lot of people that struggle to pay real estate taxes, your insurance, and things like that. So it's kind of taking the equity out of the house. So the problem for the people that would inherit your property is obviously the mortgage does have to be paid back with interest.
And the house will be so-called worth
right.
less.
So if you have a $300,000 house, it's capped at, I believe it's 50% of the equity of the house. So, if it's a $300,000 house, they'd only be able to borrow up to $150,000. So.
Which is, Now, people have, mentioned that, well, that's great, but closing costs have been traditionally high. Are they still high? I mean, there are stories of $10,000, $12,000, $14,000.
I wish. No.
No?
No. No.
Okay.
No, closing costs are a lot less. I honestly, looking back, I've been doing this 20 years, and the attorney fees are less than they were 20 years ago.
So, but closing costs in general, isn't there other costs, besides the attorneys?
There's the title insurance, which again, that rate hasn't changed in years. I can't remember the last time they had a rate change on title insurance. And lenders will have some charges, what they call origination charges, which for most banks, an origination charge might be around $1,000, which is like a processing fee that they charge.
So on a $300,000 house,
you're probably looking at like $2,000.
How much?
$2,000.
Well, that's not much.
It could be $2,000-$3,000 for that. And then on top of that, you'd have your escrow accounts. That's not a closing cost, but you have to set up an escrow account to pay your taxes and insurance.
Which you normally
which you have to pay anyway.
Yeah,
so,
anyway.
But that's all you should be paying. Other people will pay points, and that will increase your closing costs. And points are basically you're buying a lower interest rate. So a point is 1% of your loan amount. So if you have a $300,000 loan, you'd be paying $3,000 for a point. And again, you make the calculation as far as like, if I pay that $3,000 for the lower rate, how long does it take me to recoup that cost with the lower rate?
$3,000.
As opposed to having a higher rate with no points. So I don't see people paying points that much.
That was a big thing before?
It was, yeah. People used to pay points quite a bit.
So things have changed.
Yeah, people just don't like the cost of it. It's just not something that a lot of people do, is paying points.
Now, you mentioned title insurance. Could you briefly talk about what is title insurance, and is it good for everyone?
It is good for everybody. You have to purchase title insurance for the lender.
Say someone has owned a home for a long time.
Well, the land has been there from the beginning of time, so so title insurance covers you for whatever title issues might pop up.
Come up. So even if someone owned a home for 20 years, they might still think of.
Well, you don't purchase it. Usually, you purchase title insurance when you buy your home.
Okay.
All right. It's not something that you go out and purchase.
Not like
usually.
life insurance.
Yeah. I mean, people have done it, but it's rare that somebody would come out and say, I
Most
want to
people-
buy a title insurance policy. You buy it at the closing. So,
Now, do some lenders make you or tell you you have to get the title insurance?
you have to purchase it for the lender. So the lender always has a policy for itself.
Okay, to cover itself. in
Cover
regards-
itself.
yeah.
And that only covers the bank if they have to foreclose on the property and they find a title issue. Then the title insurance company steps in and says, okay, bank, we'll take care of the issue, whatever it is, or compensate you for any damages.
Now, does the title insurance company do a title before they issue the policy?
Correct. So that's my job as the closing attorney.
Check the title.
Check the title.
To assure that
Right.
the title company, that the title is fine,
Mhm.
and then they're more likely to issue the policy.
Right. So there's standards that we all go by, attorneys, as far as title standards, to run the title by. And then to protect you as far as buying the house yourself, because the lender's policy, again, only protects the lender, you purchase an owner's policy of title insurance to protect yourself for your house. It's a one-time fee. It's based on the cost of the house and also how much you're paying for the lender's policy. So, but it's a flat rate. It's the same for all the title insurance companies in the state, so it's not something that you really shop around for. And
So there's would be two policies, one for
Right,
the
one for
lender,
the
one for the
lender.
homeowner.
Yep.
And the same company, same insurance
Correct, yep,
company would
same,
issue the
right.
policies.
And so that
And it's
owner's
a
policy.
one-time fee.
It's a one-time fee for yourself, and the same thing with the lender's policy. The lender's policy, you always have to pay every time you get a mortgage. So every time you refinance, you have to purchase it. But there is what's called a refi rate on the lender's policy of title insurance. So you don't pay the full premium when you refinance.
How
You pay
about the owner's
40%
side?
off. The owner's policy, you don't have to purchase again.
Okay.
Even if you refinance, that stays with you for as long as you own the house. So, and that protects you against any title issues that might possibly come up.
What would-
Because
for
we do
example-
a title exam.
For example, what might develop?
Um,
Adverse possession or something to that effect?
Adverse possession is the one where people, there might be a dispute on a property line and people.
Guy's out there chopping wood for 20 years, and all of a sudden he says,
Yep.
this is my land. He said, what do you mean, my land goes out 300 feet? Oh, no, I've been here for 20 years chopping wood. You must have heard me.
Yep, so that's one thing. I'm involved with a case here in Fall River, a crazy case, but a legal description was done incorrectly in the deed. So 3 houses were subdivided. They were all on one parcel of land, which was kind of common in Fall River. For some reason, buildings were on one parcel of land back in the day.
Yeah, then
They
they
would
found
have
if
like
they
3 families.
subdivided it, the
They would
land,
make
they'd make a lot of money.
Right, so these 3 houses were split into 3 lots. Unfortunately, when the first house was sold, the description was for the whole parcel, all 3 houses.
Oh, well.
But then,
Lucky the buyer, huh?
then they sold the house, again, but the legal description was correct for the second time, but unfortunately, it was the first time, it had the whole parcel. And that buyer never was expecting to purchase all those, the whole parcel.
Yeah.
And then it just became a mess from there because there was a foreclosure and things like that. And it wasn't caught until the woman went to go refinance, and this was literally last year, and it happened in '96, the incorrect legal description. So
Now, is that a major problem, or is
that was a major problem, yes.
Oh, okay.
So now I had to file a petition in the land court and helping the lady.
You couldn't
take
just
care of it.
redraw the deeds?
No, it was a little more complicated.
Okay.
If there wasn't a foreclosure, then yes, that would have been the case, but there was a foreclosure that had, so that made it more
Okay.
complicated.
Because-
But it's just to
because-
give you an example of, there's no one true example of a title issue. There's lots of different title issues out there. We do title exams, but mistakes are made. Attorneys are human as much as
Oh,
people
yeah.
don't think we are.
Well,
So
I
we
mean,
are.
the case
It's,
where, the mortgages were assigned and.
Right, and that's a case where,
recently,
yeah. So you may not be buying a property from a bank, a foreclosed property, but you don't know if 2 or 3 owners before you, they might have been foreclosed on, and the foreclosure was done incorrectly. And when we were doing title exams back in the day, those foreclosures were done correctly. But then the courts looked at once the foreclosures happened and people challenged them, the courts looked at it and said, no, those weren't the correct way to do it. And so they were all done incorrectly, and that causes title issues all the way down the line for anybody that buys after that. So that's why, since the crisis happened, pretty much everybody buys title insurance.
Now,
So,
just a simple question, because people out there, you know, I'm sure you've been asked this question many times. I don't have my deed. What do I do? Do I have a real problem?
Panic. You don't own the house. That's it. It's all over. Move out. No. You
No?
do not need the original deed for anything. Okay. And a lot of people do worry about that. It's not like the title to a car. I do a lot of closings for people that are from India, and they are very concerned about not having an original deed, because over in India, that's the only proof that you have.
Is the
and it
original.
is the
If you
original
don't have the
deed. If you
original-
don't have the original deed, and there's so much fraud over there
Yeah.
as far as the public records go, that they really freak out about not having the original deed. In Massachusetts or the United States, the registry of deeds is the holder of the record.
registered
So
it.
the copy is scanned there, that's the record. So if you ever lost your deed, just go to the registry of deeds. Do not pay any fees for it. It's $1 for a copy.
And the last question, because we're running out of time, it goes by fast when I have you here, Paul. Homestead Act, alive and well?
The Homestead Act is alive and well, and they finally changed the law a few years back so that everybody has the protection, even if you don't record one at the registry of deeds. It's for the house that you live in. That's why it's called a homestead. And it protects you up to $125,000 in equity of the house. That's the automatic protection. If you record a homestead at the registry of deeds, it's protection up to $500,000.
500,000.
Yeah,
So it's good to have one,
right.
and it's good
There's
forever.
no reason not to have one.
And it's good forever. Once you do it,
It's
it's
good.
there for that piece of
Yep.
property, as long as you live there.
And that protects you in case somebody sues you, they cannot force you to sell the house to pay them off. It's not a magic pill, you still owe the money to the people if you lose the case. It also gives you some protection in the bankruptcy court as far as allowing you to exempt more property.
So you can get sued, lose the case, but you can't be put out of the house.
Right.
In other words,
To
the
pay
house
the
can-
judgment.
Okay.
Yeah.
Well, Paul, Attorney Paul Abreu, very, very good program. Once again, you always do a good job. People love
Thank
you.
you.
I'm going to tell you. Yes, I don't have to go see my attorney now. You answered all my
Yeah,
questions.
no, it's
Well, okay, thank you out there for watching, and I'll see you next time.